I am going to kind of focus in on is the third bracket, which is the 25% tax bracket. That's for single people, it's 35 to 83,000. For married, it's 69,000 to 139,000. For married filing separate, it's 34 to 69. And head of household, it's 46 to 119. Everybody see that? Yes. So when they talk about tax brackets, that is basically the adjusted gross income. Now, adjusted gross income is the income you get minus your deductions. Everybody with me? All right, so I'm not going to, that's the total amount of the tax information I'm going to give you, because the first thing you need to tell your clients is, the first thing, the middle thing, and the last thing is please go talk to your accountant. You are not a CPA, you're not a tax preparer. This is for information only. Everybody with me? I can't, if one of you gets me in trouble because you said he said, and you say something like you're in a 25% tax bracket, and in fact they're in a 33% tax bracket, and I end up in trouble over it, I'm going to spank you, okay? Naughty, naughty. You've got to think about how you're talking to your people, okay? Get this? Because you cannot, you are not tax preparers, you are not tax advisors, all right? So, let's use the 25% tax bracket, and we'll work from there. Now, by the way, this is federal. We live in a state where they charge taxes also. In the state of California, it runs around 10%. So if you've heard the words combined state and federal tax bracket, for somebody in the 25% tax bracket, they could be paying 25% federal and 10% state, which makes a total of 35%. We can go into, is it fair, is it right? We're not going there, okay? So, let's take a scenario, let's take a $300,000 house. We have a $300,000 house. We're going to buy it FHA. So by buying it FHA, we're going to put 3.5% down. So we're going to get a loan for $289,500. So write down $289,500. Now there's MMI involved in here. So the loan rate actually, the loan goes up. So this is, when I was going over this yesterday, I was talking to Debbie and Bill and reviewing this over and over and over. This gets to be very, very technical. And I'm going to lose some of you, I know. But you've got to try, I'm going to try to present it in such a way where you'll get the idea of what's going on here. So we're dealing with a $300,000 house. A $300,000 house on FHA is going to cost about $1,577 a month for the first trust deed. So write that down. $1,577 is principal and interest. Okay? The taxes on a $300,000 house are $312 a month. I'm rounding down. And the homeowner's insurance is going to run you about $42 a month. The total payment that a purchaser would be looking at would be about $1,932 a month. Everybody with me? You add those three together. Now, we have a purchaser who earns $82,000. Let's make it $83,000, round it up. The buyer makes $83,000. That means their current monthly paycheck is $6,900 a month. They've got about 25% in taxes that they're taking out, withholding taxes. So they're going to net about $51.75 a month. Their rent is about $1,350 a month. So if you take the $51.75, and you subtract $1,350 from it, you have an after-rent spendable of $3,825. You guys with me?
Yes.
$3,825. So here's where a problem starts to come in. The payment is $1,900. The rent is $1,350. Everybody with me?
Yes.
So what's the biggest objection we run into usually from the buyer is, wait a minute, I'm only paying $1,350 a month rent. Why should I buy this house that's going to cost me almost $2,000 a month? That's the objection we get. Now we talk about the deductibility of the house. Okay, that's one of the issues. Now there are other issues, and I'm going to digress just for a second. It's kind of hard to compare when you talk about a renter who's living in a two-bedroom, usually apartment-type home, maybe a condo, and now they're going to be moving up to a three-bedroom, two-bath home. You've got standard of living issues here. But they're only looking at the money going out. Get it? It's true, their standard of living is going to go up. They're going to go from a two-bedroom apartment or two-bedroom, two-bath apartment or condo to a three-bedroom or maybe even a four-bedroom, two-bath house with a nice little yard that their kids can play in. And that all has value, but it's hard to put a number on it when they're looking at the difference between $1,350 and $1,950. Now, how much is rent deductible?
Zero.
Zero, correct? You cannot deduct $1 for rent. Not that I'm aware of anyway. So that money is 100% gone. But let's look at the $1,900. On the $1,900, you have, it breaks down this way. You have $1,577 is principal and interest, but the principal and interest breaks down to, write down $1,224 is interest, and $353 is principal. You also have $312 in taxes and $42 in insurance. The insurance is not deductible in a primary residence. Your homeowner's insurance is not deductible usually in a primary residence. Your taxes, your home taxes, are. So the $312 are deductible, and the $1,224 is deductible. So you have $1,536, which is deductible. Everybody with me? And let's figure that, to be conservative, we said we were going to be in the 25% tax bracket, and we're in the 10% state tax bracket. So that we could use easily 35%, right? Say yes. I don't want to use that. I want to be more conservative. I want to be under, not over. So let's use 30%. So 30%, so we can take 30% of the 1,536, which comes out to approximately $461. So that $461 is money that comes off of the taxes that the client is going to pay on a monthly basis at the end of the year. Does everybody get this?
Yeah.